Hello, this is Alex again with MasterChartsTrading.com, and this is market recap for Friday, December 11th, 2015. This week we had some pretty strong selling pressure that appeared in S&P 500 and the general markets and other sectors, of course. But S&P 500 together with IWM, the small caps, broke November lows and closed below them. So this is an important test of the support levels. Also, many of the key sectors and industry groups within the general market followed suit and closed below the November lows. Correlations increase when stocks drop, and we'll look at some of the historical examples of that. Fear trade, I believe, is on as bonds gained for the week, and some of them actually hit multi-year highs. I think selling in the US dollar is overdone, and I think we may see a retest or reattempt to go to 52-week highs again. For now, gold and gold miners are in the middle of a bear market rally, but we'll look at where this rally may falter. And finally, we'll look at oil and natural gas, which hit multi-year lows this Friday. All right, so let's look at the S&P 500 ETF. So S&P 500 ETF SPY is kind of like a proxy for the market. So today on Friday we had, I think this is a very important development because we had a gap down here and then continuation lower, and we actually closed below the November lows and below November closing low as well. So this is a very important breakdown in my opinion, and this could be like a double top here. It's pretty obvious looking double top for now. Of course, we could just turn around and rally. That's also a possibility. But for now, I'm keeping a bearish bias. I have been keeping a bearish bias since somewhere around September, around here. Actually, when this rally failed and was a shooting star here, and I think that's where I started keeping pretty bearish bias. So if you look back, some of my blog posts and some of my videos, starting back here, already was looking at the bearish posture within the general market. So this is for now reinforcing this posture. Also, you can see the unbalanced volume. You can see it's trending lower, and new highs, new lows. I mean, this is not a very good indicator. Sometimes there's quite a bit of whipsaws. For another, I'll show maybe later on for a New York Stock Exchange Composite. I think it's more reliable than for S&P 500, the New York Stock Exchange, the new highs, new lows indicator. All right, and next let's look at the IWM, the small caps ETF. So now this one is significantly weaker than the S&P 500. You can see that we didn't even close above the 200-day moving average, and the previous chart, S&P 500, we did close above the 200-day moving average. So this one is a lot weaker chart than S&P 500, and today also we had a gap down below the support level. Right there, there's a pretty sizable gap, and continuation lower with a close below recent support levels, even below this support level. Now there is this gap up that needs to be closed. So basically we're almost there. So a little bit more downside will close this gap. A little more downside and we'll actually retest the lows from September and August. Let me just go back to S&P 500 and I can show that. You can see that S&P 500 actually closed above the 200-day moving average, above this green line. And then the same thing here, this gap needs to be closed. So that's another good place for possible support. But most likely I'm going to say that we're going to get a retest of the lows from August and September. So some of the sectors and industry groups I monitor also have shown some pretty significant selling pressure. This is XLF Financials sector. This is a really a very important sector of the market, I think. Financials kind of, determine the risk appetite, and looks like there's quite a bit of selling that took place today. Also a gap down and continuation lower with a close below the November lows. So also possible double top here. So that's one of the sectors I monitor, and it looks like we're seeing some significant selling pressure in financials. Next sector I wanted to point out is this is construction home builders ETF XHB, but this is part of the consumer discretionary sector. Same picture, a little bit weaker than XLF actually. You can see that we've been making lower lows. Also a close below November low, so that's also not a good sign, and we're most likely going to get a retest of this September low, possibly even August low. Another sector, also a very important sector, also from a consumer discretionary sector, or this is industry group. We got XRT, which is a retail. This one was under a lot more pressure than other sectors. You can see that it barely had a rebound compared to S&P 500. Here in November, we actually closed below the closing low from August, because the closing low was up here. So this was already making lower closing lows, and this is usually not a very good sign for the general market when such economically sensitive group as retail makes a lower low. Same thing, today we had a breakdown below December lows, but since we already broke below November lows, I meant August lows, this one is clearly in a downtrend, so not a good sign for the general market. Another very important group is biotech, XBI. This is a very broadly diversified ETF. Has a lot of small and mid cap and large cap stocks. It's pretty broadly diversified. Also under a lot of pressure from all-time high here. Just in July, we had a really nasty drop together with the general market, a rebound, but then you can read here there was this whole scandal with Daraprim medication that drug company was charging very large amounts of money for. It came under severe selling pressure, made a lower low here and a closing low. So anyways, it rebounded with a what I think is a rising bearish wedge, since we had a sizable drop and a rebound. But then we had what I think was a bear wedge break right here and a continuation lower, and now we closed below November lows as well. So XBI biotech, under some serious selling pressure as well. If the general market continues lower, XBI will certainly follow. So those just several groups: the financials, the home builders, the retail, and the biotech. They represent a pretty kind of like aggressive groups within the markets, within the stock market, and weakness in these groups represent a rotation of money away from the risk and more towards the safety of various safety funds. For example, bonds, which we will look at next. But first, let me show you correlations between various funds during various time periods. So this chart shows 4 different funds on the same chart. There is a red line is S&P 500, the general market. The black line is utilities. Excuse me. The green line is energy, XLE, and the purple line is consumer staples, XLP. So what I'm trying to show here is during the upside, during the normal, the bull markets, various funds kind of, move in tandem, but there's a little bit more diversity, I guess, between them. And but when the bear markets start, you can see that they all start selling hard and about the same time. You can see that same thing happened here. All of them kind of rolled over and started selling, and then they bottomed out together. Um, what I think what I'm trying to say is during the bear market, the correlations increase even more than they are during the bull markets. And if if let's say, okay, I'm going to go buy consumer staples during the bear market, or I'm going to be hiding in utilities during the bear market. The truth of the matter is you really can't hide in any of the stock funds. Everything gets sold more or less, not necessarily at the same time, but more or less everything will get sold. So if you're trying to hide in one of the defensive sectors, I think the reality is you most likely will not be able to do that. So where can people hide during times of financial stress when the bear markets and the correction start? And that's of course in bonds. So let's look at bonds next. Okay, so this is TLT, iShares Barclay 20 plus year Treasury Bond Fund, long-term bonds. So this is pretty volatile fund, honestly. It is sometimes difficult to trade, and we had this big gap down and a big red candlestick here on last week following Mario Draghi's remarks, and there was a lot of volatility last week. Now this week, this big red candlestick and a gap down was completely reversed with this movement up and then eventually a breakout. I think this is a true honest to goodness breakout above this recent high level. This is kind of like a typical fear trade. When stock markets drop, the bonds go up. So investors are rotating out of stocks into bonds, and this is a kind of classical flight to safety. Um, flight to safety. Also, this downtrending slope, rather trend line, looks like it's been broken to the upside. Now, I mean, of course, we might get a little bit of a pullback, but generally speaking, I think TLT is bullish, especially if stocks come under further pressure. Bonds are most likely going to benefit. Now, I know that we have Janet Yellen and the Federal Reserve meeting coming up on the 15th, I believe. And the consensus is that they will raise interest rates by 0.25%. These are long-term bonds. These are 20+ year bonds. So how much will they be affected by the raise in interest rates remains to be seen. I think this bonds in general, specifically the treasuries are. They respond more to amount of fear in the market than to the actual interest rates. So the fear is clearly present, and if stocks come under selling pressure, a TLT is likely to benefit. Next, let's look at MUB, which is a municipal bonds fund, and this is kind of like also a telling sign. We've been hitting from here on. These are basically all-time highs, non-stop until today. We hit another all-time high. This is telling you something about the markets when StockShares technical rank, which ranks of the universe of ETFs, non-leveraged, non-inverse ETFs against one another. You can see that municipal bonds are 92, rank number 90, in the top 10% of the funds. So that's telling you that there's just a lot of people trying to position themselves away from stocks and into bonds. And yeah, it's definitely overbought, but it's also at all-time highs. So that's quite bullish. All right, that's all I want to say about bonds. Next, let's look at the US dollar. So US dollar index, daily chart. Uh, we had this just huge candlestick here. This is when Mario Draghi announced that they will be doing less quantitative easing in Europe than the market expected. Apparently, this was bullish for the euro and somewhat bearish for the dollar. So basically, I think that this chart is still bullish. We hit almost 52-week highs. We came within, just one couple of cents from 52-week highs. So I think that now we're going to see support found somewhere maybe around here, maybe around the 200-day moving average, and possibly a rally higher again in the dollar. And especially if the interest rates go up on the 15th, that would be bullish for the dollar. So if the dollar rallies again and continues, tries to challenge the all-time 52-week highs here, then the commodities will certainly come under further selling pressure, and the commodity that is quite sensitive to the price of dollar is gold. So let's look at gold next. All right, gold spot price daily chart. So we hit a multi-year low here in the beginning of December and then rebounded pretty strongly. Again, this was last week with Mario Draghi. Apparently, market participants really were impressed by his speech that the euro, that he's going to do less quantitative easing than the market expected, and that somehow was a good sign. But in any case, the dollar did drop, so that put some relief on gold, and gold actually broke the support here from these lows here, from July lows, and continued to hit multi-year lows, but then rebounded. So for now, I don't see gold building on this potential breakout. There's lots of resistance here. There's resistance from from this level. You can see there's lots of points of resistance at 1100. Then there's the 50-day moving average up here, and then finally 200-day moving average. The 200-day moving average proved a really formidable resistance before, and several times before gold failed at 200-day moving average. For now, basically, we had a nice trade here in gold and gold miners, but for now, I'm basically staying out of the market because I'm, uh, you know, uh, this is a bearish security, and I'm not going to be picking bottoms here. What I would like to see is a rebound and then a failure, and then I will short at the failure. So next, let's look at GDX, gold miners. GDX gold miners ETF, again, same thing, strongly bearish security. Now, GDX is interesting because we had a clear support here. We had a clear support around this $13 area. And again, we failed to break down in November here, and then rebounded with what looks like a rising wedge. So this is a counter trend bounce, in my opinion. Excuse me. And I think it will continue rising until, for now, until gold decides to roll over again. And same thing as with gold, I'm really not looking to pick a bottom, but rather to find where GDX fails. And before it has failed, one time here at the 50-day moving average, and previous attempts actually it failed at 200-day moving average. So a good area for GDX to fail would be around here, somewhere in $16, $17 area. For now, I'm basically staying out of the market, and I'm looking for a shorting opportunity, which hopefully will come once the rebound is complete. All right, next let's look at oil. West Texas Intermediate light crude oil spot price daily chart. Again, bearish security. I kept saying that this is a bearish security. There was some talk about this three white soldiers and this potential breakout clearly didn't materialize. There was a rejection here at the 200-day moving average. We went ahead and shorted the oil here using SCO, and we're now up around I think almost 70%. Because it's an inverse double fund. So the subscribers got a nice alert there. I'm not sure exactly where this is going, but we could potentially break down to possibly high 20s. Just based on the measured move from here to here. This whole thing could be duplicated on the downside after this breakdown here. Because we closed below this $37 support level. So we could potentially continue lower until possibly upper 20s even. Yeah, so very bearish security. Not looking to pick any bottoms because, look, for example, this is looks like a hammer candlestick, but it immediately failed next day. So if you are trying to time the entry on the long side on this bearish security, it's very difficult. All right, let's look at natural gas next. Okay, natural gas, spot price, daily price also. Again, multi-year lows, quite bearish security as well. I pointed out last, I think a couple of weeks ago, this breakdown here. So we had a breakdown below this level, below 2.18, and I said that based on it's called a measured move, we could see a drop. Well, I was very conservative. I looked from here to here, so that's about 7% drop, and let me see, we're already 9% down. So actually, this is we could use an aggressive estimate is about from here to here, so that's 11% down, and so we're down already. What is it? 9. It's like 10% or so. So we're actually kind of getting close to the measured move target for this particular move. So potentially we could start, looking for a bottom or a temporary bottom. But again, if we're looking for bottom, for example, this is a hammer candlestick. It's right there. And also this is a hammer candlestick, and they both completely failed. So again, you have to be very careful looking for bottom in a bearish security, and this is very much a downtrending bearish security. And nobody really knows when the bottom will come. And even if the bottom does come, once the security rebounds, for example, above the 50-day moving average, now that's it was a good opportunity to short here, basically. So once the security rebounds around, maybe depending on where we stop falling, maybe it rebounds to 235 here, 230 to 40, then it could potentially present itself as a shorting opportunity again. So again, until the bottoming process is complete, and bottoming process takes a long time usually. So until then that is complete, I think I'll be looking for shorting opportunities in natural gas, but and certainly not looking to time a bottom. All right, very briefly, let me show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have trade alert services that are live. It's only $24.95 with a 3-week free trial, so please consider signing up for it. You'll get a daily market recap. I send out alerts, things I buy, things I sell. So I think it's a great value, and I am getting some pretty good feedback from my subscribers as well. Also, we do have a blog, of course, and a video section, and this video will be posted here. Also, public chart and social page. If you click on that, you will see that you can click on this link here, which is a public charts page, and you'll be taken to the public charts page where most of the charts that are presented here will be posted. Sign up for our mailing list. You'll also get a special price for trade alert services. If you have Twitter, Facebook, YouTube, or StockTwits accounts, please follow us there as well. Thanks for watching and have another great trading week. Bye-bye.